Kookie, welcome back to 2023, mate.
Here we are, Mark. What a start to the year is all
Well,
I
if
can
you
say.
compare this time last year to now,
yeah.
oh my God, what a different time of year. Like last year, we're interest rates at cash rate 0.1%.
Yep.
Mortgage rates 2%. Housing market on fire. Everything was on fire, and then of course we got COVID. But no. Yeah, no. This time last year, everything was pretty cheap. Then but we still had COVID. We'd already had COVID.
Yes, and inflation was up a little bit, but not much. And we thought, okay, the transitory inflation rate. So 12 months, what a difference.
And we were getting told by our Reserve Bank governor that, not to 2024, we should be okay.
He was still saying that, yes.
Yeah.
And my goodness, he's... look, poor old Phil Lowe, and it's every central banker actually. So I know we sheeted home to him because we're in Australia and he's our RBA governor, but every central banker around the world got it wrong in late 21 and the beginning of 2022.
Or New Zealand.
Are they getting? No, maybe the Kiwis got it a bit better, but yes, they were early to hike. They were a bit more,
November,
punchy. But here we are now, the next 12 months. Gosh, where are we going to be in 12 months' time?
Well, we had 8 rate rises, right? Was it 8 rate rises?
8
rate rises.
Yep.
And we had some big ones too, a few half percenters in there.
Yep.
So
we had 4 50 basis point ones in there.
Correct.
In one of those 8.
It was, in a record sense, probably the fastest and highest rate rise period, well, definitely that I've ever seen in 40 years, probably ever. Yep. Would that be right?
I think it is. Certainly since the late 80s, early 90s, 300 basis points in 8 months is the most number of points of rate hikes in a shortest period. And so that's why it's having an effect. Admittedly, we're coming from 0.1, so the starting point was incredibly low, but nonetheless, it's a very punchy rate hiking cycle that we're seeing.
And we've had a contraction of liquidity. So the RBA is not at their... Well, let's not talk about the government for a moment, but just the RBA is not out there buying debt and or buying assets like they were. In fact, they're around the other way. They're selling assets, releasing assets. They're trying to reduce the size of their balance sheet.
Correct.
That taking liquidity out of a market is quite important. In other words, taking the money out of the system. And it's happening not just here in Australia. It's happening all around the world.
Yep.
Money's been taken out of the system by the central banks, which means there's less cash to spend, which is therefore it's less inflationary. You and I talking earlier on, before we walked in today,
Yep.
We all know the more money you put in the system, it's going to be inflationary. Mind you, when our friends, and by the way, both sides of Liberal and Labor agreed to the policy during COVID to spend up big. It wasn't just one party. Both sides, they had to get it agreed by both parties. And it was a rough time. But they agreed to flood the market with dough globally.
Indeed. Yes.
We're not only going to build
banks too, governments and central banks. So everybody was chucking cash into the economy.
So not only fiscal policy, in other words, government spending money on stuff. The central banks are loosening the belts of the retail banks, and in fact, in our country, gave retail banks money really cheap to go and lend.
Close to $200 billion at 0.25 or less, down to 0.1 at one stage. Yes.
So, as our erstwhile friend, or now deceased friend, Milton Friedman would have said, well, no wonder you got inflation. What do you expect? What did he used to say? What was he saying?
Yeah, I think the way that we economists narrate is saying down too much money, chasing too few goods. So for a given level of goods in the economy, if there's more money being pumped into your pocket, my pocket, everybody's bank account, they go, oh, gee, I've got this money now. What am I going to do? I'm going to spend. What does the retailer do? I'm going to put up my prices because everyone's rushing me into my store. So it was simply that liquidity. And as you said, during COVID, things were grim. We thought the economy would be in its nastiest recession since the 1930s, Great Depression. So, look, to give a bit of leeway to governments and central banks, we weren't sure how bad that health effect was going to be on the economy. Where the problem came, I think now...
Too much, too long.
Too much, too long's the question. They didn't take it away early enough, as we're just sort of saying. So when it became evident, and this was evident in late 2021, inflation was picking up, the economy was recovering. They were sort of saying, it's transitory, this inflation problem. And we also knew, Steve... They were slow to do it.
We also knew, Steve, that Australians had saved $250 billion.
Yeah.
So... if you're a central bank and you see that number, I've actually seen the Deputy Governor of the Reserve Bank talk about that. The $250 billion we saved.
Indeed, yes.
Well, where do you think it's going to go? You know, I heard Milton Friedman so many times in old YouTube videos, which you can still see today, say it's not the consumer who creates inflation. It always is the central authority, because they release money to the system. If you give a person money, your point that you made earlier, if I give someone a lot of money, if I give my kids a lot of money, they're going to spend it.
Yes.
They'll spend some of it at least.
Yeah, it's like finding a $50 note on the ground. You know, find it. Okay, you might put it in the bank account, but I bet you most people would go, great, I'm going out tonight. I'm going to go and, go out for dinner. I'm going to spend that money.
Or some part of it, more than you would normally spend.
A large part of it, because that was a windfall gain. And you're quite right. During the COVID lockdowns, the policy stimulus, the cash handouts, JobKeeper. And again, it was a good policy, but it did create a lot of liquidity in consumers' pockets. And when we were allowed to travel again, remember that we were locked down.
Yep.
We didn't spend other than on Netflix and things like that when we were locked at home. But when we were allowed to go out again, we thought, geez, I'm sick of being locked down. And while we might not have been travelling internationally in the early stages, we were travelling within Australia. We were going out for dinner. Oh, I better get that new car now. I can afford to do that. No. And there was lots of money being spent on renovations. And that was part of the excess demand in the economy, like too much spending, because people had too much money. And the central authorities were slow to pull it out of the system. They're doing that now, though.
So if you looked at the inflation number, which is what we're going to talk about today, amongst other things, in terms of how it's going to affect what the Reserve Bank's going to do next week when they meet, interestingly enough, we're looking at 7.3% inflation number. Is that around the number?
7.8 was
7.8.
Was the headline inflation number.
6.9, I think, was the
core or underlying trimmed mean, whatever they call it nowadays.
That's
a little bit less, but still very, very high.
But some of the areas, one or two of the areas which I noted, which stood out to me that had increased substantially, was one of which was travel, air travel in particular.
Yep.
A big one. It's a big one. And of
travel
course,
and accommodation, hotels, and all that stuff that's interlinked to us.
Correct.
Getting on a plane and going somewhere.
You go to the Gold Coast.
Yep. Going to Melbourne, going Hobart, Tassie, whatever. Yeah, all those lovely holidays.
And you spend a lot more money when you're away.
Correct.
And those things have contributed to the big inflation number that we saw. And of course, the Reserve Bank's interested in controlling that inflation, because inflation is one of the nastiest diseases we can catch. Correct?
It is. Inflation reduces the living standards of people. So if your wages are only going up at about 3%, current numbers here in Australia, and your cost of living is going up at 7.8%, by definition, the amount of goods and services you can buy is reduced by 5%, and that is stuff that you no longer can afford to buy. You just simply can't do it. So living standards decline, which is why, just to take a little bit of a history lesson for 20 seconds, it's why in the early 90s, the RBA decided, and then it was confirmed by Peter Costello when he became Treasurer in 1996, that we have an inflation target for the Reserve Bank of 2 to 3%. That was seen to be sustainable, decent, and if people got a 3 or 4% wage increase, they'd be getting a little bit ahead every year. That's why it was such a good target to have, and in the last year, we've blown it.
So, yeah, and just some context around the history lesson with what happened in 1996 when they landed on that 2 to 3%, which is, by the way, we're still at 2 to 3%. That's where the RBA wants to be. It's all about maintaining a certain standard of living, whereby cost of living will, if it increases out of control relative to your wages, in other words, if inflation's much higher than your wage increases, which is where we are at the moment, by definition, over time, your standard of living will reduce. And it's
Correct.
a big deal. It's a big deal. Yes. Central banks and governments don't want. They get marked on the standard of living of the people who live in the country.
Correct,
and that's their mandate.
So they should. That's why we elect these guys to office, and girls. We want them to run the economy in the interest of the whole economy. So at the end of the day, my standard of living, your standard of living, my kids, they're a little bit better off than they were 5 years ago, and that's the nature of the game. And high inflation erodes that. In fact, sends us backwards. If inflation stays too high for too long, we actually go backwards. That's why it's such a bad thing.
So the counterintuitive part of all that, of course, is if you jack my interest rate up by 41%, which is where it is jacked up for those people who currently got a variable rate at the moment, my standard of living is also going to reduce, because I'm going to be in a lot of pressure to stay where I am. And also, if I can't borrow money anymore, or I'm a new buyer and I can't borrow money anymore because the interest rate that I'm being assessed against as to my ability to repay my loan from the lender that I'm trying to apply for a loan from, if that's so high, they say you can no longer borrow any money, Mark or Steve. So I'm now pushed into the rental market, of which we have limited supply. Rents go up, which also reduces my standard of living.
Correct. The housing market's in a real quandary right now because of that exact point that you mentioned. So those people with a mortgage and with a variable mortgage are about to roll off their fixed rates in the next 6 to 9 months.
I heard 800,000.
800,000. I think the RBA acknowledged that in earlier testimony this week. They were talking in front of a parliamentary committee, 800,000 people. So those people and others who are already riding up the variable rate hikes that we've seen last year are forking out somewhere between $500 and $1,500 a month. $500 and $1,500 per month averages close to $1,000. $12,000 a year out of your after-tax income. Extra, over and above what you're paying anyway. Yeah. And that means that you don't have, let's just say, the $12,000 a year. That's less that you've got to spend on other things. So, okay, there's probably a point where we can all cut back a little bit. But cutting back $12,000
is a lot
for someone on average or slightly above average earnings or that sort of thing with a big mortgage, and when your inflation rate's high, so your cost of your electricity, your groceries and these sort of things is going up more than your wage, it's the real squeeze. And that's why I think very simply, consumer sentiment is in the doldrums. It's sort of bouncing around these low levels, but it's at a level that's consistent with a recession. That's why we consumers are feeling pretty pissed off at the moment with our financial position.
Well, the question is now they're going to raise rates in February, so let's go through your great strategy board.
The checklist. Yeah, it's been 2 months since we last updated it, and there's been a lot of economic data, a lot of news that will have impacted the checklist. So let's start at the very top. GDP. How's the economy going? And again, we saw the September quarter GDP figures come out in December. The economy is growing reasonable pace. It's slowing down a bit, so I think that one is in neutral. We're currently growing, but not too hot, not too cold. Inflation, tightening. We've discussed that 7.8%. Headline inflation, 6.9%. Core inflation, it's too high. If that was the only thing in the world the RBA looked at, it'd be easy. They'd be hiking like crazy. The labour market, I'll still keep that in tightening because we've got a 48-year low unemployment rate, 3.5%. So again, that's suggesting to the RBA that if it continues to stay at these levels, we get wage pressures, which is the next point. Actually, I put wages in neutral because they haven't yet picked up, but they're worried that they might. So those top few things feed into the rate hiking, the tightening side of the economy. International economy. I'm going to put that verging on easing, even though the US, European Central Bank, New Zealand, Canada, they've all been hiking, including this week. The GDP outlook has slowed down. It looks like we're having, I won't necessarily call it a recession, but something of a hard landing in the US, UK, Europe. They've got an economic weakness position coming through. So if that was the only thing you'd looked at, you think, well, gee, Australia's a big trading economy. That would be negative for us. House prices, don't shoot me down here. I'll put that in the easing case. They're now down 9% peak to trough Australia-wide. Sydney's off 13%. Melbourne, Brisbane's now catching the disease.
Brisbane's just under 11%.
Yep. So we've got big falls, double-digit falls.
But they rose huge, though.
True.
Yep.
But be careful what you wish for. Those people thinking, we want housing affordability improved through house prices. We know that if they fall too far too quickly, you end up dislodging the whole economy. So while it's an easing number, I'm saying that cautiously because you don't want house prices to fall massively. Okay, retail sales. I'm putting that in neutral. We had a really weak retail sales number for December, but that was after a couple of strong numbers in October.
11 months worth of rises.
Correct. And we consumers had been spending like crazy. There is a possible problem with the way the Bureau of Stats calculate the number because we brought forward spending into November, Black Friday sales and that sort of stuff. So that number was up. So December's down. I'll keep that at neutral, but it does appear as if we consumers are starting to pare back a little bit of our expenditure. So it's neither up nor down sort of thing in terms of where we're at. Consumer sentiment, I mentioned that before. We are gloomy consumers.
Yep.
Cost of living pressures, rate hikes, our house has gone down. We're feeling a bit, miffed with our lot in life.
Especially mortgage holders.
Correct. Building approvals. taking a bit of a hit now. This is an interesting one because I'm putting that in the easing side. We want houses to be built. If you're fair income, if you're the government or state government or local government and you're fair income about getting enough houses, you want them to be built. Now, the building approvals numbers have been trending down and down and down. They're weakening very sharply. Exactly at the time we've got immigration rocketing up. That's fine because it addresses the labour market skill shortages, but it's putting pressure on houses. Where are these people going to live?
Yeah, totally.
Renting or buying? As you're saying, we've almost run out of rental properties, housing, that we don't have a lot of them around. So I put that in the easing side. Business investment, pretty good. It's growing. Businesses are sort of revamping their capex on buildings and structures, equipment. I'll put that in the neutral column. Same with business confidence. The NAB survey came out a week and a half ago. Businesses are saying, things are pretty good. We're doing okay. So you don't need to hike for the business sector being too strong or cut because it's too weak. Commodity prices, I'm going to put that erring between tightening and neutral. Iron ore price, which did get below $100 a tonne in December, now is $120 a tonne. Great for Australia. It gives us an income boost. We know that some other commodity prices have come down, but with China reopening, demand for commodities is going to pick up. So that one's sort of erring between neutral and tightening. Stock market is doing pretty well. It's rebounded. Well, I think as we sit here now, the year today, it's up about 8 or 9%. Now, you don't hike or cut because of the stock market, but I'm putting that in the neutral side of the system. If we had a stock market crash, that hits wealth, and you perhaps say, the central bank would be biased to ease, and if we've got a booming stock market, they're biased to hike. Bit of a recovery, doing okay. Last one, current rates. I'm putting that in the neutral column. Official cash rate, 3.1. It's probably erring on slightly restrictive, not massively so. So in theory, if most of these other indicators were all more in the neutral column, you'd say leave them steady. But 3.1 is about neutral. The question for the RBA and next week at the February board meeting is, do they want to move this red button more towards the easing side because they've actually tightened enough, or tightened, I won't say too much, but certainly tightened enough.
In other words, have they got to what they consider to be acceptable neutral?
Neutral to slightly restrictive. So to making sure that people who have debt, and let's not forget the business sector, they've got debt too. They've got to manage their overdrafts and their loans and the like, and they don't want to have their fingerprints on over-hiking into a weak world economy where they cause a recession. I know it's being a little bit melodramatic, but the RBA is well aware of the risks to the downside. So where interest rates are now, 3.1, they're not killing the economy, but they're getting close to being that restrictive side of their ledger.
So if I look at this, we've only got 2 in the tightening column. In other words, 2 of the factors to actually increase the rates.
Correct, and they're really important.
What about
ones.
The weight? I was going to say, some of these things carry less weight than others. For example, the stock market, carries less weight than inflation.
Absolutely,
so,
yes.
And I guess the reason you got GDP and inflation and labour market at the top of your column, is because they have the heaviest weighting on them.
Indeed, and this is sort of in order of weighting. GDP is sort of recession or economic boom. Inflation, we all know. Labour market, does everybody have a job? Wages, international economy. These things are down the bottom are important. Oh, don't get me wrong. Business sentiment, building approvals, consumers, retail spending. They're important, but they are not as important as the actual inflation rate or GDP growth and these sorts of things. If
I was to say to you, therefore, what do you say is going to happen this week? Do you think we're going to get a rate increase this month?
Until recently, I thought no. I thought that some of these factors that were in the neutral to the slightly easing ledger of the checklist, and from what actually the RBA governor was talking about late last year in December, he gave a few speeches and was signalling, we might be on hold and we'll see what happens. But in literally the last week, I think I've had to change my mind. I was wrong. I think that when they meet next week, they will look at the actual inflation rate. They'll look at the fact that the labour market, the unemployment rate is still incredibly low. And they'll look at the international side. And while the international GDP is weak, the fact that most, if not all, of the other major central banks have hiked, and that almost all of them have a materially higher official interest rate than we do. So we're currently 3.1. If they hike, we go to 3.35. The Fed's at 4.75. New Zealand's in the fours. UK's in the 4 point something. So is Canada. We're at 3.35. So I think they'd probably err on the side of hiking. And I dare say the statement that they always put out with interest rate announcements will be longer than normal. And they'll sort of outline this reason for the rate hikes and why they're not on hold. And I dare say there'll be a paragraph flagging, for the first time in 12 months at least, downside risks to the economy.
Do you think, or do you agree, you may disagree, with Deutsche Bank, who's now saying 4 rate rises, or our good mate Bill, who's been on this podcast, saying at least 2?
2 and possibly 3, but no recession. He was very... I listened to his talk the other day.
The Westpac are doing podcasts. I think they took a leaf out of our book, mate.
I think they did, yes.
Copying us.
Good on your Westpac. We love you.
But Bill had been the chief economist there.
Oh, indeed, yeah.
So do you do you subscribe to their views? I personally don't. I think if we got one more rate rise, I think that's it.
I'm with you, Mark. Look, I think this rate hike, if it is in fact delivered next week, and let's assume that it's delivered, will be that final, hit to consumer confidence for mortgage holders and the housing market, which is already very weak. Both construction of new dwellings, house prices, house lending, all of that stuff. And that is a really important part of the Australian economy. Whether you like it or not, housing is a dominant issue for the way the Australian economy functions. And interest rates, clearly, are a very important driver of what happens in housing. So they've already delivered 300 points of hikes, as we said, the most aggressive tightening in many, many decades, not just years, decades. They go one more. If they were to go 4 more, and Deutsche Bank, look, I respect their research a lot. They've got fantastic economists there. But I think to get 4 more rate hikes and say another 100 basis points already on top of the 300 that are there, and their timing is by August this year, I think they were saying. That's when these loans are, the mortgage cliff loans, or 200 and something billion of them, 800,000 people, their loans are rolling over into not only where we are now, which is actually pretty painful, as we were saying, but another 100 points on that would be really
these guys are going to be
over-egging it.
More than double what they're currently paying on a monthly basis.
Correct. And so where are they going to... And okay, maybe hopefully people have saved a bit of money or they're anticipating it. So
they've spent it because we know we've got inflation.
That's right. So I think that if Deutsche Bank, for example, are right with 4 more hikes, we'd be on the edge of recession, if not in a recession, if they did that. And as you're saying, Philip Lowe, the RBA governor, does not want to cause a recession. He's had a checkered period as RBA governor, with all due respect. He does not want to end his tenure as governor as the bloke who caused a recession in 2023, 2024. So I think he'll tread carefully. And but just by the way, the risks on inflation are starting to turn if we look at what's happening in the global economy and these sorts of things that we outlined on that neutral to slightly easing side of our checklist.
I agree with you 100%, and I think that this is his last year, so his term finishes sometime later this year.
I think it's September.
Yeah, and he doesn't. My gut feeling is that they're not going to put him back there because of we've got a Labor Party, whatever.
A whole host of reasons.
Just a whole host of political reasons, policy reasons, and political reasons. So I don't think you'll get another run. So you're right. He doesn't want to end his career in that regard by putting us into recession when he doesn't need to put us in recession. So I think he's going to tread very carefully. I agree with you. I also think, Steve, and just to finalise all this, I reckon if they put one more rate up, just for the sake of it, and do nothing else, just the diminution or the reduction in the amount of liquidity in the economy, it'll do the job for us going forward over time, like month by month, there's just less money available.
Correct.
And I remember Bill Evans many years ago, and I got a bit annoyed when he said it, but many years ago, talking about the prosperity dividend that the mining companies deliver to the country as a result of commodity prices being so high. And I was never a real believer in it because I used to say, well, I don't own any shares in mining companies. I don't get a dividend from them. I don't actually get anything. I don't feel as though I get anything out of a mining company doing particularly well, Fortescue or whatever it is in Australia by selling to the Chinese, ridiculous prices and huge amounts of volume. But actually, that prosperity dividend showed up in the COVID years and actually did end up in everyone's pockets somehow, somewhere, in some silly way. But now that prosperity dividend, or just money, available money, is being withdrawn from not only our economy, all economies around the world.
Yeah.
And I reckon that it's going to do the job just the same as it did the job of creating inflation. I reckon it's going to start to reduce the cost of living, reduce the increase in cost of living. I just get that feeling.
I agree with you. And one thing that's under analysed, I don't have it on my checklist, and it rarely is spoken about in economic circles nowadays, is the money supply.
Totally.
They produce numbers every month.
I know.
Nobody looks at them.
Well, they're down. I do.
Yes. Oh, I look at them occasionally.
It comes sometimes referred to as M1 or M2.
Yes, and in the middle of COVID, of course, as you were touching on with all the bond buying and cheap money, it shot up. I can't remember what the year-on-year increase, like 20%. Yeah. So there's money everywhere.
It was the largest increase we'd seen in 35 years.
Yes, since the bad old days of the 1980s high inflation period. Now it's come down. It's like a chart. It's like a cliff. It's come down, and the rate of slowdown because the money being withdrawn from the economy, from the rate hikes, from the ending of bond buying from the Reserve Bank, from the ending of the term funding facility, the bank's actually going to have to start paying that back.
Yeah, now. They're starting now.
A little bit at a time. A couple of $1 billion, a few more billion. Where's that money coming from? It's from the economy. It is actually de-leveraging the economy, which feeds into your earlier point about good old Milton Friedman. There'll be less money chasing the same amount of goods. What happens to the rate of inflation? It starts coming down. So I think that's one of the other things that's important with, just say we get one more rate hike, that once we start getting those in monthly inflation numbers for January, February, the quarterly inflation number for March, which comes out in the latter part of April, I've got a sneaking suspicion that number's going to be very, very low in headline terms because petrol prices are down from where they were. That airfare issue, they're now back lower. You've got other commodity prices coming off, so I wouldn't be at all surprised if when we get that March quarter number, it'll be like 0.5 quarter on quarter, the lowest in about 2.5 years. And the RBA is saying, we might be getting really close to getting inflation back under control.
And what we've got to remember too, and what our listeners got to remember is something that's really important here is petrol prices might not come down, but the question is, have they gone up? This is about price increases.
Yes, inflation is the rate of increase.
Yeah, yes.
So it went from
that's really important.
It is important. So inflation going for petrol, again, I'll only be hopefully 30 seconds, from $1.50 to $2, that's a 33% increase in inflation on petrol. $2 stays at $2, inflation the next year, zero. Because, you still think, gee, I'm paying $2 a litre, that's really mean. But the rate of inflation
is the rate of
zero.
The price increase.
Rate of increase, yes, correct, Mark.
And that's really, really important. Yep. The question is, can airfares go up from here? No one's going to pay them.
And I'm hearing from, and maybe this is the international side, but some of the big international airlines, Emirates, whatnot, are now adding to capacity. They realise that they're selling every damn seat because we can't wait to go over to Europe and America and Asia, whatever. So they're actually adding to capacity, which means that some of those prices will probably come down. So let alone like the oil price, it goes from $2 to $1.80, let's say, that's minus 10%.
Yeah, so and that has an impact. Big impact on the number.
Yes, it has a big impact on this sort of stuff and the actual consumer price index, which is the rate of inflation.
Correct. So we're looking at price increases for the next tightening move by the RBA if they indeed do it. Right now, they're dealing with a 7.9% number and a 6.9% underlying inflation number, CPI number. So they're probably as you say, they're probably getting their hands forced right now. But the question is, will they continue to do it? Bill Evans, by the way, says 2 or 3, but he's also saying there's going to rate reduction later this year.
And Mark, really importantly, with the Fed hiking earlier today, as we're recording this, they've got one more priced into their futures market. And then by the end of the year, so only in 11 months, with one more rate hike in March, I think it is, they've got 150 basis points of rate cuts, 3 50-point rate cuts priced into the US, such as the market's pricing of the risk that inflation will be falling sharply in the US and the Fed, whoops, we might have done a little too much. Let's start taking away some of that tightening. And that obviously has some impact on us here in Australia.
Totally. Kooky, thanks as usual, mate. And I will be hanging out at 2:31 on the next Tuesday, first Tuesday of Feb, and to see whether you got it right. And I bet you did.
We'll see how we go. Thanks, Mark.